All right, today we are diving deep into the Aritas Vinyl IPO. Now, on the surface, this thing looks like a story of absolutely explosive growth. But our job as serious investors is to look past all that hype and ask the really tough questions. Is this a golden opportunity or is it a high-risk gamble? Let's find out.
Okay, let's just get right to the heart of the matter here. Aritas Vinyl was founded in April 2020. You heard that right, 2020. That is an incredibly short history for a company that's now asking for public money. So the question that's going to guide our entire analysis is pretty simple. Is this meteoric rise a sign of a true rocket ship in the making, or is it just a massive red flag?
And to answer that, we're going to break this down just like a professional analyst would. We'll start with who they are, then we'll dig into why they're asking for money in the first place. We're going to stress test their business model, put their financials under an X-ray, uncover the risks hiding in the fine print, and then we'll deliver a final data-driven verdict. So first things first, let's get a crystal clear picture of the company at the center of all this. So who exactly is Aritas Vinyl? Well, they're in the technical textiles space, which is really just a fancy way of saying they make artificial leather. You know, the stuff you find on couches and car seats, shoes, handbags, that kind of thing. They're a B2B company, which means they don't sell to you and me. They sell their materials to other companies who then make the final products. But the detail on this slide that we have to keep coming back to is that date, founded in 2020. Now for the big question in any IPO analysis. Why are they doing this? You know, if you follow the money, it always reveals the real story. And the prospectus tells us there are really two things going on here. First, the company is raising new money for itself through what's called a fresh issue. That's brand new shares being created to fund the business. But at the same time, some of the existing shareholders are selling their own shares in an offer for sale. This is a really crucial point. This IPO is designed to do two things: fuel the company's growth and let the early insiders cash. Okay, so the money the company is getting, where's that going? Well, a big slice is for working capital. You can just think of that as the day-to-day cash needed to buy raw materials and keep the lights on. The rest is going into a new solar project and some other general expenses. And, you know, on the face of it, these look like pretty standard goals for a growing company. But here is something that every single retail investor has got to see. Buried in the prospectus, it shows that some of the promoters got their shares for as little as 3 rupees and 85 paise. Meanwhile, you, the public investor, will be paying the final IPO price. That massive gap in what insiders paid versus what you're being asked to pay, well, it begs the question, who is this IPO really set up to benefit? All right, let's shift gears and look at the business itself. Every company claims they have strengths, but our job is to figure out if they have a real, defensible competitive advantage, what serious investors call a moat. In their prospectus, Aritas lists the usual suspects. They say they have experienced promoters, a modern factory, lots of different customers, and a real commitment to quality. Now look, these are all good things to have, but let's be honest, they're also pretty generic. This is the kind of stuff any manufacturing company would claim. It doesn't exactly scream unique or unbeatable. Which, of course, brings us to the million-dollar question. In a super crowded market like textiles, does Aritas Vinyl actually have a protective moat around its business? Or is it just another boat in a very rough sea? And you know what? This is why you always read the risk factors. The company tells you the answer themselves, right here in their own words. They say they're in a highly competitive environment and are subject to pricing pressures. Let me translate that for you. It means they have almost no power to set their own prices. They have to cut prices just to keep their customers. That, my friends, is the exact opposite of a competitive moat. All right, time to put on the gloves and perform a full financial X-ray. Numbers don't have feelings. They don't have a marketing agenda, so let's see what story they're telling us. Now, this is fascinating. This table tells a story of contradictions. On the one hand, look at that top line. Revenue and profit are exploding upwards. That looks amazing, right? But then you look just below that. Total debt is also ballooning, climbing higher every single year. And then you get to the most alarming number. In the most recent period, their operations actually started losing cash. Let's just pause on that growth number for a second. A profit growth of over 1,500% in just 2 years. I mean, wow. That's the kind of headline number that gets people really excited. It's the whole foundation of their growth story. But is it for real? Is it sustainable? And here is the reality check. Profit on paper is not the same thing as cash in the bank. The numbers show that in the 5 months leading up to August 2025, their business operations actually burned through 294 lakhs in cash. This means that despite those big profit numbers, the business itself wasn't generating enough cash to survive on its own. It was cash negative. That negative cash flow is the perfect lead-in to our next section. It's time to start connecting the dots and look at the major risks and red flags that are hiding between the lines of the prospectus. Okay, let's just recap the red flags we found so far. We've got an extremely young company. It's being fueled by more and more debt. It recently started burning through cash just to operate. It has no real competitive advantage in a tough industry, and it's listing on the SME platform, which is for smaller, riskier companies by its very nature. But there's one more flag we need to talk about, and it's a big one. The prospectus shows that Aritas does a lot of business, both buying and selling, with a company called Elegant Vinyl. The thing is, this is a group company and it shares directors with Aritas. These are called related party transactions, and for serious investors, this is a major corporate governance concern. It creates all sorts of potential conflicts of interest around pricing, fairness, you name it. So we've seen the impressive growth story, and we've uncovered some pretty significant risks. Now it's time to put it all together, weigh the evidence, and make a final call. The company actually gives us its own peer comparison, so let's see how they stack up. The return on net worth, which is basically a measure of how efficiently they make profits with shareholders' money, is about 20%. That's decent, for sure, but it's not exactly best in class when you put it next to a more established player like Mirza International. So the takeaway here is they're a solid performer, but they're not a clear industry leader. All right, let's be very, very direct about this. Who should even be thinking about this IPO? Given this risk profile, this is only for aggressive, higher-risk investors who are really experienced with how volatile the SME platform can be. For pretty much everyone else, safe, conservative, moderate, and especially beginner investors, this is a clear avoid. The short history, the high debt, and the governance questions just create too much risk. So after all of that, what's our final verdict? In one word, avoid. The high risks, the rising debt, and the questionable governance just completely outweigh the impressive but very possibly unsustainable growth story. So to leave you with the 3 key takeaways, here they are. 1, remember that all that explosive growth is being fueled by risky debt. 2, the business is not yet self-sustaining. We know that from its negative cash flow. And 3, those related party deals are a major governance red flag that you just can't ignore. When you weigh all the evidence, the gamble here just looks way bigger than the potential reward.